On March 15, 2023, something happened that should have dominated headlines worldwide, but barely registered for most Americans. Saudi Arabia publicly confirmed that it would accept Chinese yuan for oil exports to China. Not only United States dollars, but yuan. And for the first time in almost half a century, the largest oil exporter on earth agreed to sell its most strategic commodity in a currency other than the dollar, quietly cracking the petrodollar arrangement that had been in place since 1974. That decision was not just another trade agreement, it was the sixth step in an eight-step collapse cycle that has already destroyed three previous reserve currencies: the Portuguese real in the 16th and 17th centuries, the Dutch guilder in the 17th and 18th centuries, and the British pound in the 19th and 20th centuries. And now the United States dollar is tracing the same path, crisis by crisis, stage by stage, with the dangerous twist that we are entering the phase in which alternatives are gaining momentum and the shift speeds up instead of slowing down. The key truth almost nobody is told is that reserve currency status is never permanent. It is a long arc that usually runs about 80 to 110 years. A country rises, its money becomes the preferred unit for trade and savings, power peaks and is overused. Rivals quietly build competing systems, confidence begins to fracture, other options reach scale, a shock accelerates the exit, and finally a replacement or a multipolar set of replacements takes over. This pattern has played out 3 times in roughly the last 5 centuries, and every time the dominant empire convinced itself that its money could never be displaced, that it was uniquely safe, uniquely indispensable, and every time that belief turned out to be catastrophically wrong. The dollar today sits in roughly stage 6 of 8. Serious competitors are already functioning. The petrodollar lock is breaking. The BRICS bloc is constructing parallel plumbing for trade and payments, and if you map the current trajectory against prior cycles, you get a window of maybe 10 to 15 years before the dollar stops being the single central reserve currency. Not vanishing as money, but losing its privileged position. And when that happens, the long era in which the United States could print almost unlimited amounts of currency and push much of the inflation abroad ends abruptly. The roughly $36 trillion of federal debt becomes impossible to roll over painlessly. Borrowing costs jump, and average American living standards fall by something like 30 to 40% as the artificial subsidy of reserve status disappears. To see why this matters, you have to be clear about what a reserve currency actually is. A reserve currency is the unit of account that central banks and governments choose to hold as their primary foreign exchange reserves, the asset they use to settle trade, pay external obligations, and defend their own currencies during crises. When a country's money becomes the main reserve currency, it gains 4 enormous advantages. First, it enjoys built-in demand. Every nation that wants to participate in global trade must accumulate that currency, so they are forced buyers regardless of what the issuing country's domestic economy is doing. Second, it gains seigniorage, the ability to create new units of currency at home and swap them for real goods and services from abroad, so that the issuer sends paper or digital claims while receiving cars, electronics, energy, and raw materials in return. Third, it can borrow far more cheaply than fundamentals justify because global savers treat its government bonds as the safest storage asset and line up to lend at low yields. Fourth, it can spread the impact of its own money printing across the planet. When it expands the money supply, the resulting price inflation is shared by every foreign holder of that currency rather than being felt only at home. Taken together, those advantages constitute the greatest economic weapon any state can wield, but they also mean that when reserve status slips away, the pain is severe. External demand evaporates, borrowing costs spike, printing money creates immediate domestic inflation instead of being diluted globally, and the standard of living that had been propped up by decades of seigniorage drops back toward what the real productive economy can support. That is exactly what happened to Imperial Portugal, to the Dutch Republic, and to Britain, and the early stages of the same process are visible in the United States now. The 8-step cycle looks like this in simplified form, and you will hear echoes of earlier empires in every step. Stage 1 is the rise and consolidation of dominance, where economic strength, technological advantage, and military reach combine to make one country the obvious anchor of global trade, and its currency naturally becomes the unit that merchants and governments trust most. In the 15th and 16th centuries, Portugal controlled the sea route around Africa to India and the East Indies, using heavily armed caravels to dominate the spice trade in pepper, cinnamon, cloves, and other goods that were literally worth more than gold by weight. Fortified ports like Goa, Malacca and Macau turned the Portuguese real into the standard currency across large parts of the Indian Ocean. In the 17th century, the Dutch built the most efficient commercial system in Europe, with Amsterdam as the unrivaled trading hub, and the Dutch East India Company, often estimated as the richest corporation in history, with a modern equivalent valuation in the trillions of dollars, financed fleets that carried timber and grain from the Baltic, spices from Asia, and goods from the New World, while the Bank of Amsterdam and the Amsterdam Stock Exchange gave the guilder a reputation for reliability and liquidity that made it the leading currency for international settlement. In the 19th century, Britain defeated Napoleon, built the largest empire ever seen, controlled roughly 1/4 of the world's land and population, and backed its pound with gold at a fixed rate, so that by 1900 something like 60% of world trade was denominated in sterling, and London was the clearinghouse of the planet. After the Second World War, the United States emerged with about half of global economic output, overwhelming industrial capacity, unmatched military power, and most of the world's gold. At Bretton Woods in 1944, the dollar was made convertible to gold at $35 per ounce, and other currencies were tied to the dollar, making it as good as gold in practice. And even after President Nixon ended formal convertibility in 1971, the Petrodollar deal of 1974, under which Saudi Arabia and other OPEC states agreed to invoice oil only in dollars, preserved its central role. But embedded in this peak is stage 2, overreach. At the top of the mountain, the leading power almost always takes on commitments it cannot sustain, fights expensive wars, builds sprawling bureaucracies, and borrows heavily to maintain an oversized footprint. Portugal tried to station garrisons and fleets in dozens of distant ports with only a tiny home population, and began financing empire with debts so large that interest payments swallowed most royal income by the middle of the 16th century. The Dutch Republic fought repeated naval wars with England and land wars involving France. Its commerce-based economy was never designed to support permanent mass armies, and by around 1700 its defense spending strained the state as trade profits slowed. Britain, while still ruling from India to Africa to the Caribbean, faced a rising Germany and a rising United States, and spent heavily on the Boer War and on keeping the Royal Navy far larger than any rival, funding much of that through London's bond markets until by 1914, Britain, once the world's creditor, was heavily indebted to New York. The United States, flush with post-war dominance, poured resources into the Vietnam conflict, the broader Cold War, and later Gulf and Middle Eastern campaigns, while expanding domestic programs, ultimately running debts that passed $10 trillion by the time of the 2008 crisis. Yet the dollar remained supreme because habit and lack of alternatives kept everyone using it. Stage 3 begins when others quietly construct their own tools. Watching the hegemon run up debts and abuse privilege, emerging powers create parallel trade routes, financial hubs, and payment systems, so they are less exposed to the dominant currency. Spain and England built their own East India companies to compete in Asian trade, gradually displacing Portugal's ships and its real. England and then France encouraged their own exchanges and central banks, nibbling at Amsterdam's monopoly. After the First World War left Britain financially weakened and dependent on American loans, New York rose as a rival to London, and the new Federal Reserve System made the dollar a credible alternative reserve asset. In the modern era, after the 2008 meltdown made clear how fragile the Wall Street-centered system was, China and Russia began to lay down their own infrastructure. China launched the cross-border interbank payment system as a homegrown alternative to the Belgium-based SWIFT network. Russia set up its own system for transfer of financial messages, and the BRICS nations began discussing a common trade currency while signing more and more bilateral deals to use local money instead of dollars in trade. At this point, the intention is defensive, a hedge, not yet a full-scale replacement. Stage 4 is when the dominant power begins using its currency as a club and pushes partners into those alternatives. Portugal tried to bar Dutch and English merchants from key ports. Britain blockaded Dutch shipping during war. Those moves pushed competitors to build independent ports and alliances that ultimately undercut Portuguese and then Dutch power. London's use of financial sanctions and asset freezes during early 20th century wars made neutral countries think twice about holding pounds. The United States has taken this weaponization much further. In 2014, Washington responded to Russia's annexation of Crimea with targeted banking sanctions, and Moscow responded by shrinking its dollar reserves and bulk buying gold. Then in 2022, after Russia's full invasion of Ukraine, The United States and its allies froze roughly $300 billion of Russian central bank assets and severed most of its banks from SWIFT, proving to every government on Earth that dollar reserves can be switched off by political decision. That single move probably did more to accelerate global de-dollarization than any speech or policy in decades. China cut back its holdings of United States treasuries from around $1.3 trillion a little over a decade ago to well under $1 trillion today. Saudi Arabia trimmed the dollar share of its reserves. Central banks worldwide began buying gold at the fastest pace since the 1970s, and more countries joined or deepened involvement in non-dollar payment systems. Stage 5 arrives when confidence clearly frays and the reserve share starts to slide in visible data. After Dutch and English competition shattered Portugal's monopoly, the real's use in Asian trade fell from a clear majority to a minority over a few decades. After British blockades and Napoleonic disruptions, the guilder went from cornerstone of European finance to a secondary unit. The pound's share of global reserves dropped steadily between the First World War and the 1950s as nations diversified into dollars and gold, and the Bretton Woods system formalized what markets had already started to do. The dollar followed the same arc in slower motion. Its share of global foreign exchange reserves peaked around the end of the 1990s at roughly 71% and has since drifted down to the high 50s, with several percentage points of that loss occurring in just the past few years. Once that decline gets underway, it has never reversed in prior cycles. Stage 6 is the tipping point in which alternative systems reach enough scale that the old network effects begin to operate in reverse. For decades, the logic was simple. Almost all trade was invoiced in dollars, so everyone needed dollars. So banks catered to dollars. And because it was easiest, everyone continued using dollars. But networks can flip, and we are watching the early signs now. When Saudi Arabia, the pivotal swing producer in global oil markets and the core of the 1974 Petrodollar deal, agrees publicly to sell crude to China in yuan, it sends a signal to every other energy exporter and importer that oil does not have to be priced in dollars. When Brazil settles more trade with China directly in reals and yuan, when India buys Russian energy in rupees and rubles, when the United Arab Emirates accepts yuan, when the BRICS bloc expands to include major resource states like Saudi Arabia, the United Arab Emirates and Iran, and when China's CIPS handles tens of trillions of dollars equivalent in payments in a year, the convenience of using the dollar everywhere begins to erode. At that point, merchants, banks, and governments start to find that in many corridors it is actually simpler or cheaper to use something else. Yuan in Asian trade, local currencies in South-South flows, maybe a future BRICS-linked trade unit for commodities. That is the phase we are edging into now. Stage 7, which has not yet arrived but is approaching, is the panic phase, when a war, a financial accident, or a policy blunder triggers a scramble for the exit. For Britain, the Second World War and the Suez humiliation were that shock. The empire spent itself into bankruptcy defending against Germany, ended the war owing an amount around 3 times its annual economic output, and then in 1956 discovered that the United States could threaten to dump sterling and crash the pound if London did not obey Washington's demands over Suez. From that point, sterling's status as equal to the dollar was finished. For the dollar, the trigger could take several forms. A successful launch of a BRICS trade currency explicitly linked to gold, or a basket of commodities could persuade oil and gas exporters to quote prices in that unit, drastically reducing structural demand for dollars. A loss of faith in United States Treasury bonds, as interest costs on a $36 trillion federal debt push annual interest payments toward or beyond $1 trillion, and investors demand much higher yields, could force the Federal Reserve either to print huge amounts of new money to buy the bonds, or to let rates spike and crash the economy. A simultaneous overcommitment to conflicts in Eastern Europe, the Middle East, and East Asia, without clear victories, could shake confidence in American power more broadly. A wave of defaults in commercial real estate, triggering failures among hundreds of regional banks, could undermine trust in the United States financial system. Any one of those, or some combination, could start a rush by foreign central banks and sovereign funds to dump dollar assets and move into gold, yuan, or other holdings, driving the currency down sharply in a short time. That is the real collapse phase. Stage 8 is the new equilibrium, when a successor dominates or when no single currency is dominant, and several share the role. When the Portuguese system imploded, trade moved to Dutch and English units. When the Dutch system gave way, sterling took over. When Britain was exhausted, the dollar rose. This time the endpoint might look different. China's yuan is the leading contender to grow into a more central role because of the size of China's economy and its trade web. But capital controls and political risk make many countries wary. The euro could serve as another pillar. The BRICS could formalize a gold or commodity-anchored trade unit that functions as a neutral settlement layer. Gold itself may return more explicitly to the core of the system, not as everyday money but as the anchor behind state-level balances. The more likely outcome is a multipolar world in which the dollar still matters greatly but accounts for perhaps 1/3 to 2/5 of reserves and trade, with the euro, the yuan, and some form of gold, backed or commodity-linked instruments sharing the rest. Several factors will make this transition faster and rougher than earlier shifts. Digital finance allows trillions of dollars in reserves and claims to move at the speed of light, rather than at the speed of sailing ships. Alternative infrastructures from SIAPs to regional payment systems already exist rather than needing to be invented from scratch. The petrodollar system, unlike earlier trade dominance, was built on a political promise between Washington and Riyadh that can be and is being renegotiated. United States indebtedness relative to its economy is far higher than Britain's or the Netherlands at comparable points, and global integration means that a dollar crisis will transmit instantly into every corner of the financial system. If you map all of this on a timeline, you can see the arc. Roughly from the turn of the millennium through the mid-2000s, the dollar sat at the unquestioned peak, reserves near 71%, almost all oil priced in dollars. United States military power unmatched. That was the late part of Stage 2. The 2008 crash and its aftermath opened Stage 3, as China and others decided they needed options and quietly built them. The first major uses of sanctions in 2014 and the extraordinary money printing of 2020 began Stage 4, the weaponization phase. The freezing of Russian reserves and cut off from SWIFT in 2022 and Saudi Arabia's willingness to accept yuan in 2023 mark the line between Stage 4 and Stage 5, when confidence begins to slip in earnest. We are now in the blend of Stages 5 and 6, where shares in reserves and trade are sliding, and alternatives are big enough that the network effects can start to reverse. If history rhymes, then sometime in the late 2020s or early 1930s a shock will push the system into Stage 7, and by the middle of the century the dollar will probably have settled into its new, reduced role. In that transition there will be winners and losers. Holders of physical gold and other scarce real assets have almost always done well during reserve currency breakdowns. During the long unraveling of sterling's dominance, gold's price in dollars rose from the fixed $35 per ounce level to many times that as convertibility ended and inflation took hold. Resource-rich states that can sell oil, gas, metals and food in multiple currencies gain bargaining power. BRICS members and other countries that escape exclusive dependence on the dollar gain strategic flexibility and insulation from United States sanctions. Nations with low debts and strong productive bases, like some of the smaller developed economies, may see capital flow toward them as investors flee over indebted systems. On the losing side, the United States will have to adjust from a model in which it could run perpetual trade deficits of hundreds of billions of dollars per year, consume more than it produced, and pay the difference with pieces of paper everyone else treated as reserve assets, to a model in which it must either export more, import less, or accept a lower standard of living. Ordinary Americans holding savings mainly in dollar cash, bank deposits, or government bonds will feel the erosion in purchasing power as the currency declines relative to others and as inflation or financial repression are used to manage the debt. Foreign governments and firms with large dollar liabilities will be squeezed in turbulent markets. The giant financial institutions that have grown fat on decades of dollar-based global intermediation will see business migrate elsewhere. And the United States federal government will lose the ability to fund every political promise with borrowed money without immediate consequences. The harsh reality is that this is not a moral judgment, but a structural pattern. Every reserve currency so far has followed the same broad life cycle, and the dollar has already passed the midpoint. The breaking of the petrodollar in 2023 was not an isolated story about Saudi Arabia and China. It was the visible sign that the network which kept the dollar at the center of world trade is loosening. If the previous cycles are any guide, the world has roughly 1 decade to perhaps a decade and a half before the dollar is just one important currency among several, its share of reserves and trade somewhere in the mid-30s to maybe 40% range instead of the majority, with the rest split among the euro, the yuan, and some form of gold or commodity-anchored unit. When that day arrives, the 50-year era in which the United States enjoyed a free lunch by issuing the one indispensable currency will be over, and the bill for decades of easy money and accumulating debt will come due.